MLM Resolve. Let me try the technology. Yes. What is MLM Resolve? It was really born of a desire to add value to our referral partners. And while we were debating what you might find valuable, it certainly became clear that the environment in which we all operate, it's changing at a phenomenal rate. There's legislative changes, particularly in this area, market changes, and things are changing so quickly that it can be difficult to keep up. At the same time, we face huge time pressures, and it's not always easy for us to take a day out of the office to go to a training course. They can also be extremely expensive. So we set up Resolve, which is really a knowledge initiative, where we're sharing updates, legislative changes, and our expertise with you in free 1-hour seminars, which come alongside CPE points. But we can make it easier still for you because you can attend in person as you're doing today, or you can watch at your leisure online at our dedicated microsite mlmresolve.co.uk. But Resolve's more than about seminars. I thought when looking at Resolve, what is it that I value from a referral partner? And so once I got over the issues of Easter eggs and champagne, what I really value is being able to pick up the phone to someone, to a tax specialist, for example, or to a lawyer, and say, look, I've got a problem. I think this might be the answer. What do you think? And know that I can do that with people, but they're not automatically assigned a matter number and the clock isn't ticking. So Resolve is offering this to you too. You can have access to our senior team members, and their details are on the team sheets in your packs. And you can discuss with us any issue that you might have concerns about or that your clients have concerns about. We also offer you and your clients options review. There's more details in the pack. And insight briefings are also available on the Resolve website. And this is really all about trying to build mutually beneficial relationships with existing referral partners and hopefully with potential referral partners too. Today's seminar, the first in the series, is taking a look at some recent legislative changes, including changes to the Bankruptcy Act and to the setting up of the Business Debt Arrangement Scheme, which certainly we take the view offers a lifeline to partnerships and sole traders. So why these topics? Scottish insolvency figures, personal insolvency figures, are falling dramatically and have been doing quite steadily over the last 2 years. But what those figures disguise is increasing creditor activity in the marketplace. So whilst bankruptcies are down by 50%, within that, creditor petitions have actually increased by around 26% in the last 12 months. And the principal actor in creditor petitions is HMRC, which means for the accountants here that, and potentially also the solicitors, your clients are now at far greater risk of fairly aggressive action by HMRC than they were 2 or 3 or 4 years ago. Now, last year saw significant changes to the Bankruptcy Act, and therefore my colleague Nikki Williams, also in the front row, she'll talk you through some of the major changes that came in the Bankruptcy and Debt Advice Scotland Act. BADA. Do they ever think of that before they entitle that? The other subject for today is the Business Debt Arrangement Scheme. Again, introduced, the regulations were introduced in around November last year. December. Okay. I'm in the audience for the business DAS part, trust me. It's an initiative of the Scottish Government, and it was set up to help unincorporated SMEs manage periods of financial difficulty. And why is this important? Basically, before this scheme was introduced, there was no formal way for small unincorporated entities in Scotland to reschedule their debt or to manage a period of financial shock, unlike the position in England and Wales, where the individual voluntary arrangement scheme had been around since 1986 and the partnership voluntary arrangements for the same period. And yet, SMEs, and particularly unincorporated SMEs, form a significant part of Scottish business. There are over 300,000 private sector enterprises in Scotland, 98% of which are small businesses, i.e. they have fewer than 50 employees. But of these, 68% are sole traders and partnerships. So there was a fairly significant chunk of our private enterprise which faced the choice of thrive or die. So I think it has been a very welcome initiative, and my colleague Ian Brown will be here to provide you with more detail and background to that. So without further ado, I'm going to hand over to Nikki Williams, who's a director at MLM and a licensed insolvency practitioner, and she's going to speak to you about the Bankruptcy Act.
Good afternoon, ladies and gents. This will hopefully be a bit of an informal jaunt through the changes that the BADA Act has actually brought to sequestrations and trust deeds. The real focus of the presentation is the debt arrangement scheme, but we felt it was a good opportunity just to go through the main changes. Now, last night when I was preparing for the presentation, I decided to Google BADAS, and it came up with someone you might have difficulty getting on with. Now that's possibly, excuse me, why it's called the BADAS Act then. The idea of the BADAS, I mean the aims are laudable. It is to, ensure debtors had access to a fair and just process of debt management, and fundamentally those that can pay should pay. And that's basically there to ensure that creditors get the best return. Now, a lot of these changes have been driven by creditors, and despite what the insolvency practitioners have been telling the government for a lot of years, suddenly things have flipped and we're back to the stage where we have long periods of bankruptcy. People are in bankruptcy for a longer period of time. So what I intend doing is just going through the process and highlighting the main bits, but what I really need is a glass of water if somebody has one. The main thing that impacts on trust deed sequestrations and the debt arrangement scheme is the introduction of the common financial tool. Now basically that is a means of assessing disposable income that individuals have, so that the same figure is used when they consider all of the processes. It limits disparity across the possible options, and basically you know what you'll be paying despite what process you go into. Now, there's an issue, I mean, I'm not sure if any of you are actually aware of the common financial tool and the allowances it makes, but it's not generous, let's put it that way. So with each insolvency practitioner must now apply those principles, so there should really not be a huge variance between which insolvency practitioner you go to as to the results of the disposable income. Now that's a big thing for the insolvency practitioners. We have to make sure that we're applying those figures, those trigger figures, and we will be reviewed. And if an insolvency practitioner is always seen to be giving somebody the maximum amount of money that they're allowed under those trigger figures, then how we assess that will be brought into question. So it's not suddenly we can say everybody, you come to MLM and you'll always get the maximum. We have to evidence that and justify it. Now, the big thing for the individuals is the fact that there is now a moratorium. And people can give intimation that they intend to apply for a DAS, apply for a trust deed, or make themselves bankrupt. And what will happen is they'll get a 6 weeks moratorium from pressure from creditors. During that, it's not competent to serve a charge and commence diligence to enforce payment and whatever. There's various other things you can't do, but they are the principal changes. So I'll just go to my slides. Now, the general changes, which I'll just run through, is mandatory money advice. So if anybody's considering any of the options, then they must be able to evidence that they have approached an insolvency practitioner or a money advisor and considered all their options. Now, basically, this is all has come about. The idea is the Scottish Financial Health Service, where people are signposted to the appropriate solution for their debt and just are not being railroaded into one process. I've discussed the common financial tool. As I say, it is now used across the board. This slide's actually been taken, I think, from the Accountant in Bankruptcy, and it says contingency allowance. I'm not aware of any contingency allowances that have been provided for. We have move on to financial education. Again, this is part of the Financial Health Service, and this is where an individual who is in a bankruptcy situation, you can choose as the insolvency practitioner to put them forward for financial education. You have a set period to do it, and there is certain criteria. For instance, if they've been bankrupt before or been in a DAS, and basically they can show that they've got a history of recurring debt. The new route into there are two routes into bankruptcy now, aside from a creditor petition. You have what's called full administration and the minimal asset process. Now, the minimal asset process is generally for people on benefits. It has a different entry specification. You must have debts of not less than £1,500 and not more than £17,000, and not have assets of more than £2,000. That excludes a car, because anybody with experience of bankruptcy, obviously a debtor's allowed to keep a car to the value of £3,000. This is a 6 months discharge. It is £90. It's basically bankruptcy light. The thing you need to consider if you're advising anybody is that they might meet the criteria, but should that criteria change within the 6 months, then they can flip into the full administration. So there is uncertainty there. You can't guarantee that they will be in that process and out in 6 months, because if their situation improves, then the accountant in bankruptcy will flip them into full-blown sequestration. The decision review refers to matters that were once possibly with the courts, that now the accountant in bankruptcy's remit is really increased significantly, and the first port of call for any appeals and whatever will generally be the accountant in bankruptcy. Then there's a further appeal assistant process to go to the sheriff. So that's really just saying that the accountant in bankruptcy is taking over the world, and he can now do everything. That takes in the transfer of court functions, because they're now taking on some of the less contentious issues that the court would deal with. The BRO changes refer to bankruptcy restriction orders, and what happens is that the accountant in bankruptcy can deal with a bankruptcy restriction on a bankrupt when the basis the restriction would be for 2 to 5 years. More than that, 6 to 15, then it would go to the sheriff for consideration. What's changed now is that there can be an interim order if the accountant in bankruptcy thinks that there's an urgent need to protect the public. And the sort of 2 to 15 years, obviously there's degrees of culpability there in how you're actually going to be assessed to do the bankruptcy restriction order. The debtor contribution order, now this is the thing which kind of gets me going a bit more than anything, is the fact that somebody comes in to see MLM, we assess their situation, we decide that bankruptcy is the best option, we look at their finances, we assess them against the common financial tool, and we come up with, for instance, you can pay £200. It goes to the accountant in bankruptcy to be awarded. The accountant in bankruptcy look at the common financial tool, apply their figures, which should be the same as our figures, and suddenly this person can afford to pay £400. And what they'll then say is that bankruptcy is the wrong option and they should be in a DAS. So it's shifting sands all the time. It's very difficult to give advice to people because what you're actually saying to them is, well, I would assess you at this, but actually somebody else further up the chain can change that. And when you're giving people advice and they're in very difficult situations, they want to kind of be certain as to what's happening, and unfortunately that's not what's happening. The accountant in bankruptcy can decide, for instance, that you should be in a DAS because they want to encourage people into a DAS, but sometimes obviously bankruptcy is the best option, and it takes away freedom of choice almost. People can't decide what option they want because they will be funneled into what the accountant in bankruptcy deems to be the appropriate solution for them. Now, discharge process, as I said, in a minimal asset or a MAP sequestration, that will be 6 months. In a normal bankruptcy, it should be a 1-year discharge. It's not an automatic discharge. Actually, the trustee has to report on conduct, assets and liabilities and whatever, and there is a timescale for that report to go in. The accountant in bankruptcy will consider it. They will tell creditors what's happening, and they can consider representations. But the aim of the Act is that the debtor should be discharged in 1 year. What's new is often you get appointed an accreditor, petition bankruptcy, and you actually never find the debtor. And what would happen is, just through the normal process of law, that debtor would be discharged, and basically they come back from Spain a couple of years later and, you know, Bob's your uncle, they're clear of all the debt. That situation has changed. Now you can actually have a definite an indefinite bankruptcy, or you're bankrupt forevermore. So that's a bit of a change, and that's kind of running through those, but there are a few more changes. An overview of sequestration. I mean, obviously I'm sure most of you know this, but you have to be insolvent, surprise, surprise. You must be resident in Scotland or have a place of business, and there's a minimum debt level depending on the route. So we've discussed a MAP is 1,500, a full-blown sequestration is 3,000, and you must have apparent insolvency, which is obviously an expired charge for payment, a stat demand, a failed trust deed. There's other criteria there. It does include all your assets, so there's no scope there to avoid your assets other than a car at £3,000. The process has changed in that you must evidence that you have had proper financial advice, and there must be a declaration from the person giving you that advice that you've taken it on board and you've considered your options. We talked about a contribution from your income. It's now called a debtor contribution order, and one will be set regardless of whether you can afford to pay it or not, because if they set it at nil, they can come back and reassess you for it. So the fact that it's nil doesn't mean you're going to go through the whole process not paying anything. The standard period has gone from 36 months to 48 months, but you do have the right to request a payment break. Now, we've gone through discharge. Another, so I won't do that again, but another thing that is worth mentioning is acquirenda. So despite the fact that the debtor might have been discharged after 1 year, the trustee, if they inherit money, win the lottery or anything, and the 4-year period from the award of sequestration, then that can be classed as acquirenda and can fall into the estate. Prior to the 1st of April, once you were discharged, if you inherited money, won the lottery or whatever, that was fine, it was yours. But now this is a consideration. Now, if the trustee's been discharged, there is scope that the trustee can go back into office. So there's your neighbour thinking everything's hunky-dory, and then somebody finds out they've inherited money, and lo and behold, I'm chapping the door again and saying, by the way, I want that. So again, that's another uncertainty. You're basically telling people that they are bound by the terms of this bankruptcy for 4 years, despite any discharge that they might have. Now, Maureen suggested that creditors were the driving force behind some of the changes. I mean, that's probably more of a consideration in trust deeds where market forces have actually dictated some of the changes. But the fact is, despite their contention that we don't deal with their claims and it's our fault they don't get paid, you can be chasing claims for a couple of years. So they've brought in this section where claims must be submitted within 128 days of giving notice. So that puts a bit of pressure on them to actually engage in the process. Now, trust deeds, now that everybody is assessed using the Common Financial Tool, and now that sequestrations are 4 years, there is a clear distinction between the processes. And you look at a trust deed and you might wonder why people want to get into a trust deed. The big thing is that you can obviously exclude a property in a trust deed. I'm not sure how often it actually happens, but you can exclude your property if you have the secured creditor's consent. So that might be something that makes you think that a trust deed is the right option for you. We've got here that to go into a trust deed, you must be able to meet a dividend of 10 pence in the pound. That's not a statutory obligation. This is what I was saying about market forces dictating. This is what creditors insist must be paid. And if you can't meet that criteria, then they will object to the trust deed. So they did discuss putting it into legislation that there would be a minimum dividend level, but they've left it to creditors to decide. The minimum debts are 5,000 compared to 3,000 in a bankruptcy, and you must be in employment or receipt of a private pension. It doesn't work if you're on benefits. As I say, you can exclude the property, and the only other asset that you're allowed to keep an asset of £3,000 if it's your car. Creditors can object to a trust deed, so when somebody goes into one, there's no guarantee that they're coming out of it. And if they object to obtaining protected status, then you can flip into bankruptcy. And again, you've got a 48-month payment term. We go back to this assessment of income on the Common Financial Tool. And again, you've set a figure, and if you send it to the accountant in bankruptcy and you say, this individual wants a trust deed, and here's the calculation. If that debtor could pay off their debts within 5 years, the accountant in bankruptcy will not register it as a trust deed because they would assume it could be a DAS, so therefore they're flexing their muscles there. Again, the Common Financial Tool is the same. They will assess it again. If they think it's a different figure, they might ask for an increase in the payment, and they want you to evidence expenses. Now, how do you evidence if somebody's got a prepaid meter, or there's lots of problems, and I understand it from people that have put some work through the AIB since the changes that there's still a lot of teething problems, so I'm sure there's much to go. Now, the accountant in bankruptcy, in my mind, all this legislation is basically there. They've made things more difficult for the actual insolvency processes, and I think it's with an aim and a drive to get more people into the debt arrangement scheme. And I'm not an expert on the debt arrangement scheme, but I know a man who is. So if I can introduce you to Ian Brown, please.
Thank you, Nikki. Oops. So the debt arrangement scheme, an increase in consumer debt and a rise in the number of insolvencies prompted the Scottish Government to establish a debt management tool to support individuals with one or more debt without the strain of going through the court system. So DAS came into force as the debt arrangement scheme in November 2004. And the regulations were relaunched and updated on the 1st of July 2011 and further amended in July 2013 and then again in December 2014. So with the new Bankruptcy and the Debt Advice Scotland Act in April 2015, the BADA Act, as you said, has heralded the formal introduction of the new dedicated business DAS and, as mentioned, brought the Common Financial Tool into force for DAS, sequestrations and trust deeds. And the Common Financial Tool, as Nicky's also mentioned, was there to introduce a level playing field and enforce the ethos that everyone who can pay should pay. Oops, sorry, gone the wrong way. So what is the business debt arrangement scheme? Well, just to start with, DAS is a statutory scheme initially set up to help individuals. However, the innovative application by some advisors of the debt arrangement scheme for sole traders and partnerships inspired the Scottish Government to develop and launch a dedicated business DAS with the Debt Arrangement Scheme Scotland Amendment Regulations 2014. So when I joined MLM in 2010, because we were dealing with a lot of sole traders and partnerships who required solutions to repay their debts, it became apparent that a DAS could be used for this. Although the debt is repaid in full with interest and charges frozen, it has the major advantage over formal insolvency of protecting assets. So if a sole trader or partnership had an asset such as a house with equity, this would not require to be sold to repay the debt. So we adapted the DAS to help small businesses experiencing financial difficulty to manage their debt and survive, and we currently manage over 270 DAS cases. A third of these relate to small businesses, and this has helped preserve around 450 jobs. And when they were developing the business DAS, I was invited to represent the Insolvency Practitioners Association in the Scottish Government's Business DAS working group. So we were helping to contribute to the Business DAS legislation. And it was certainly interesting being in those discussions to hear the different viewpoints that were coming across, particularly from HMRC. We obviously have a lot of dealings with HMRC. There's a lot of HMRC debt in the debt arrangement scheme. And I'll come on to talk about more how the experience we've had with that. So how does it work? Well, the debt arrangement scheme, it's similar to a pro rata payment plan or a debt management plan, where clients make one monthly payment which is then distributed on a pro rata basis to all creditors. DAS can also act as a diligence stopper to stop things like earnings arrestments or attachments. Debtors can retain assets under a DAS, so they can keep any property or other assets they have. And under a DAS, once it's set up, a single regular payment is made to an approved payments distributor. And as long as you stick to the agreed payments, your creditors can't carry out further enforcement action against you. Likewise, creditors are able to take enforcement action against you if you've intimated an intention to apply for a debt payment programme or have an application awaiting approval. So DAS freezes interest and charges on the debt from the date the proposals are sent to creditors. Clients can have single or multiple debts, except it's slightly different in a dedicated business DAS where they must have 2 or more debts. Joint DASes can also be set up, and sole traders and partnerships can apply for the scheme, or directors of limited companies with personal debts. So some of the key facts about the business DAS. So the new dedicated business DAS can apply to qualifying businesses which must be in Scotland or have been formed under Scottish law. So for example, a partnership, a limited partnership within the meaning of the Limited Partnership Act 1907, a corporate body other than a company registered under the Companies Act of 2006, trusts and incorporated bodies of persons could also apply for a business DAS. So one of the main differences between a DAS and a dedicated business DAS is that the business DAS must be signed off by a registered insolvency practitioner, and it also must allow for the repayment of the debt within 5 years. So the fact that an IP is having to sign off on the viability of a business DAS, which can potentially then be overruled by the accountant in bankruptcy, has sparked some debate in certain professional circles. It seems odd that a qualified insolvency practitioner is less able to make a decision on the viability of a business than a member of the AIB staff. However, so far there's only been one dedicated business DAS in Scotland, which was set up through MLM Solutions. So it's yet to be seen if this becomes an issue, but I'll go on to discuss this more when I come on to the case study. So some of the other key facts, as I said, it must be set up by a qualified insolvency practitioner. Proposals must receive the relevant consents from interested persons, meaning that creditors have the option, as with a DAS, to consent or object to a business DAS application. All qualifying debts must be included at the time of application, although in a business DAS, ongoing creditors don't have to be included. And a declaration of viability signed by the insolvency practitioner must be submitted with a business DAS application. And the case can be referred to the accountant in bankruptcy if creditors don't accept the proposal. Again, insolvency practitioners in a business DAS must review the case every 12 months and must apply for a revocation if it's no longer found to be viable. All cases must be completed in 5 years. In a business DAS, there's no offer of composition. However, in a personal DAS, if the DAS has been running for 12 years or 80% of the debt is repaid, then there is the potential for composition. And at that point, the money advisor would contact the creditors to see if that might be an option for them to write off some of the debt. The DAS register has also been updated to allow for searches on business DAS cases. So one of the main reasons for introducing a dedicated business DAS was to deal with the issues which partnerships who were entering a DAS had. So prior to the business DAS, if a partnership wanted to go into a debt arrangement scheme, then all the partners, unless a husband or wife are cohabiting, would have to apply for a DAS each. And then on a yearly basis, what would happen, because of joint and several liability, the full amount of the debt would have to go into each debt arrangement scheme. And then on a yearly basis, a variation would be carried out by the money advisor to reduce the debt accordingly, depending on how much had been paid in under from each partner. So the actual partnership itself didn't go into the DAS, but all the partners did. And obviously this is because in Scotland, a partnership is a separate legal entity. However, in the new dedicated business DAS, one partner is signing off for the partnership, and they are then responsible for communicating with all the other partners involved in the business DAS. So they're signing off on the DAS. So some of the problems that would occur prior to this is HMRC could still sequestrate the partnership and leave the partners potentially in a DAS. So just a timeline of how the debt arrangement scheme and also the business DAS works. There's no difference really in the way setting them up works. So initially, what we would do is meet with the client, obviously, establish their circumstances, find out things like if they're a homeowner, how much disposable income they have, so we can work out the term of the DAS. In terms of personal DAS cases, the current average length of time is 5 years and 4 months. But again, the difference is a business DAS at the moment has to run for under 5 years. We'd also find out things like if there's any action being threatened or taken. Now, if it transpires, for example, that a sequestration petition's been lodged and a court date is imminent, we would then submit an intimation on behalf of the debtor. This then allows the debtor's solicitor to appear in front of the sheriff and to ask for a continuation to complete a DAS application. Now, in most cases now, a sheriff will allow this to happen. Although I have had cases where a debtor insisted on appearing themselves as they didn't want to pay for a solicitor, even though I'd advised them to get a solicitor to represent them. And needless to say, unfortunately, in those cases, the sheriff granted the sequestration. We also sometimes have cases where people will maybe contact us very late in the day. So I have had instances where somebody's contacted me at 10 to 5 on a Friday saying, I've got a petition hearing on the Monday morning, can you do anything to help? So in that case, what we did was we managed to get an intimation in place for them, and then when the solicitor appeared on the Monday morning, they were then able to ask the sheriff for a continuation to allow them to apply for a full DAS application. But normally, out with this scenario, an intimation will provide a 6-week moratorium against further diligence, and under the new BADA regulations, that now applies in sequestration and trust deeds as well. So after we've submitted the intimation, we then contact the creditors to confirm the debt amounts, and we then proceed with the DAS application once the debts have been confirmed and the debtor returns our engagement letter and confirms that they want to proceed. So debtors can't do a DAS if they're bankrupt or in a trust deed. However, if the trust deed's not become protected, then a debtor can apply for a DAS instead. Also, if there's a conjoined arrestment order against them, so if there's a situation where there are two creditors who have a joint arrestment order against a debtor, then they wouldn't be able to apply for a DAS under those circumstances. So as I said, at the initial interview, we go through the fact find, establish the situation, how much they can afford. We also explain that they can get free advice from Citizens Advice Bureau or the local council. We obviously charge a fee for the service, but it's entirely up to the person if they then choose to go to the Citizens Advice. However, the real difference with the business DAS is they don't have that option under the business DAS. It must be signed off by an insolvency practitioner, so free advice isn't available. The implications to the debtor are it goes on the DAS register. It can affect their credit rating. However, it's not really the DAS that directly affects their credit rating. It's more that when creditors issue defaults has an impact on the credit rating. If you're a sole trader or partnership, you can still maintain ongoing creditors, but you must tell them you're entering a debt arrangement scheme. And in a business DAS, you can exclude creditors. So once the appropriate documentation has been completed and the proposals are submitted to the creditors have 21 days to respond, and they can either consent to the scheme, object to it, or if they don't respond within 21 days, it's taken as deemed consent. Now, for a personal DAS application, that would be done through the Debt Arrangement Scheme Hub, which is an online system. In terms of the new business DAS, it's still a paper-based application at the moment, but we'd hope that it will move on to the Debt Arrangement Scheme Hub. So after 21 days, when we gather all the replies together, we then submit the information to the DAS administrator for approval, and the DAS administrator is the accountant in bankruptcy. If all the creditors agree, then the scheme will be automatically approved. However, if some creditors object, then the AIB then have to carry out what's called a fair and reasonable test. What they do at that stage is they then assess the situation, so they look at the timescale the DAS is over, they look at the percentage of debt that any creditor is objecting to, and they also consider various other factors, so we can put forward other information at that point as well. The DAS gets reviewed on a yearly basis, and it's the same for a business DAS, but in the case of the business DAS, it's the IP who must carry out the review. So as I said, generally, the average timescale for a DAS now in Scotland is 5.4 years. However, generally, if you can get them under 10 years for a personal DAS, then it's likely to be accepted. We do have some cases that are running for 15 years, and we've been able to do that by adding in what's called a discretionary condition to the debt arrangement scheme. Now, this means that, for example, if the debtor has a property that's on the market for sale, what they can do is we can include that as a discretionary condition in the scheme, and it's the same for business DAS as well, to say that when the property sells, then that will be paid directly into the DAS, reducing the term. So although on paper maybe those cases look as if they're going to run for 15 years, in reality the hope would be that the asset is going to sell and it's going to clear that debt. If clients have a substantial change in their circumstances, or if a debt's been omitted, a debt that was in existence when the DAS was set up, not a new debt that's incurred, then we can submit a variation on the DAS, and as long as all the creditors agree, that can be added in, or if their circumstances change. So for example, if they have a drop in salary of 50% or more, you can apply for a payment holiday, which can last for up to 6 months. In a personal DAS, that 6 months can be added on to the end of the term. However, in a business DAS, again, the debt still has to be repaid within the 5-year period. So if somebody is having 6 months off from paying their debts in a business DAS, they're going to have to make that up to bring it within the 5 years. So what are some of the stakeholders once a DAS is set up? Well, there's the creditor, the DAS approved money advisor, which the money advisor is classed in the regulations for the business DAS as an insolvency practitioner. But there's also a DAS approved money advisor for personal DASs, the payment distributor and the DAS administrator. It's an agreement that allows you to pay off your debts over an extended period of time, and the programme can be for any amount of money or any reasonable length of time. And as long as they stick to their DAS or business DAS payments, then the creditors are bound by the scheme and can't take further action. So if a DAS application fails, what happens at that point? What you can do is you can only do one intimation a year. So once you've submitted your intimation for a 6-week moratorium, you can only do one of them per year. But you can do as many DAS applications as you want. I did have a case recently where we actually had 6 DAS applications that went in. And the issue with it was a property developer. It was roughly about a £5 million property portfolio. Had about £600,000 worth of equity in that. So he was keen to protect that. He didn't want to go down the bankruptcy route. He wanted to repay his debt. He had a debt to HMRC, approximately about £200,000. So what we did was we set up the original DAS application. We submitted it to the creditors, HMRC being the main one. We also tried to include a discretionary condition to say that when the property sold, he would pay the money into the scheme. The intention was he was trying to sell a property straight away to pay a lump sum into the scheme. So unfortunately, we were unable to sell the property. HMRC rejected the application and the DAS application failed. In order to stop HMRC from continuing with sequestration, what we did was we then submitted a new DAS application straight away, and that continued to give them the protection of the legislation. So to cut a long story short, we ended up doing 6 DAS applications basically, and eventually on the last DAS application, he managed to sell the property, pay a lump sum into the debt arrangement scheme, and that allowed us to get the scheme set up. But written into that scheme, there are also another couple of discretionary conditions where he's going to be selling some properties and paying them into the scheme at a later date. So he's currently repaying his debt and is continuing to trade. So the other options available, also discussed at the start, would be sequestration of or a trust deed. However, both of those are formal insolvency options, whereas a DAS is a voluntary arrangement with creditors covered under the DAS regulations. So the context of which a DAS as a solution may apply would be an individual, sole trader or partnership who wants to repay their debts and has assets to protect. Now, DAS, once it's set up, is listed on the DAS register, which is a public register available at dasscotland.gov.uk. So I've got a couple of recent case studies here, which I'd just quickly like to talk about. The first one was prior to business DAS being set up. However, he would still have done a personal DAS because he's a sole trader. So the situation was, it was a excuse me. It was a sole trader who owned a bus company. He had 25 employees, a debt to HMRC of approximately £100,000. He had credit cards and other debts of approximately £50,000, and he owned a property with equity of £100,000. He had some other assets. Some of his buses were owned, but they were mostly leased. So I sat down with him, agreed a figure which was affordable on a monthly basis, and submitted the application to the creditors, giving them the 21 days to respond. Now, it worked out that he would be able to repay the debt in just over 7 years. All the creditors accepted the proposal, except for HMRC, who rejected the proposal. The case then went to the fair and reasonable test to make a decision, and we submitted information in support of the application, highlighting the potential loss of the 25 jobs in the community, so it's going to have an impact on the local community. The fact that in a sequestration, the return to creditors would be significantly less than in a debt arrangement scheme, and the fact that the DAS was not over an unreasonable timescale. In this case, the AIB overturned the objection and forced HMRC to accept the DAS. So he continues to trade to this day, and his debt is being repaid, freezing the interest and charges. So it was a successful outcome. It helped save 25 jobs, and the debts are being repaid, and he's managed to retain his property and his assets. The second case study is a dedicated business DAS and also a personal DAS. So the situation was it was a partnership who were husband and wife. They own a hotel, and they've got total debts of around 180,000 owed to HMRC. There's no equity in the hotel. They also have a bed and breakfast, which is operated as a sole trader under the wife's name only, and they have total debts to that of around 34,000, again owed to HMRC for personal tax and to credit cards. But there is equity of around 400,000 in the guest house property, the bed and breakfast property. Prior to this, submitting the business DAS and the personal DAS, we had two previous normal DAS cases, because at the time the regulations hadn't changed. What had happened in both of those circumstances, the first time they hadn't maintained the ongoing liability to HMRC, therefore the DAS was revoked on that basis, and the second time HMRC again rejected it, so the DAS didn't even get set up. So when we were setting up this, so because it's a partnership, we're now having to look at a business DAS for the partnership and a personal DAS for the sole trader. So I met with clients to discuss the business DAS. We assisted them with the preparation of a detailed 12-month financial projection. That included the monthly payment available to the business DAS and the personal DAS, as well as all the fees. Again, the business DAS was signed off by a licensed insolvency practitioner to confirm the viability for the next 12 months and submitted to the creditor. And the personal DAS proposal was submitted to the creditor by the continuing money advisor as normal. In both of these cases, we included a discretionary condition to say that when the property is sold, mainly the guest house, then the equity from that would then be paid into the debt arrangement scheme and clear the debt in its entirety. So again, HMRC rejected both applications. Both cases were then submitted to the fair and reasonable test, and again we went through the process of submitting the information to show that if the if the DAS wasn't approved, then obviously there's going to be a loss of jobs, 13 jobs in this case, plus the two partners, as well as that, the impact on the local community, and also the fact that hotels, when they are sold or potentially put on the market for forced sale, then they do tend to just sit on the market, so there may not be an option. The hotel's probably just going to sit there for a few years without it being sold. So the AIB overturned HMRC's objections and approved both the business and the personal DAS cases. And then what happened, there's now a new review process which has come in again. HMRC then appealed the business DAS decision under the new review process. But again, the AIB came back to us for further information, which was submitted in support of the application, and the AIB dismissed the review and upheld the DAS approval. So thankfully that case has now been set up. The both applications, as I said, included the discretionary condition to pay the DAS on the sale of the properties. That case is set up. The debtors are continuing to trade. Hopefully the property will sell in the next year or so, and they'll be able to clear that in its entirety and move on. So in that situation, for the business DAS, the monthly contributions were £4,500, and that was going to run for 40 months. And in the personal DAS, it was £600 a month they were paying, and that was going to run for 57 months. So both were under 5 years anyway. So 13 jobs were saved in the hotel and the guest house. And the intention is for the debts to HMRC and other lenders will be cleared in full, and obviously it's protected their property as well. So what are some of the lessons we've learned from working with the debt arrangement scheme? Well, some creditors are less prepared to accept the scheme than others. We do have issues where some say they never received the paperwork, even though it's sent by recorded delivery. And we ensure that we send it by recorded delivery so that we can then go back to them, so that they don't have the option to say that, because obviously if they don't respond within the 21 days, it's then taken as deemed consent. Some of the difficulties we still have are some are unfamiliar with the scheme because it's under Scottish law only. So if it's an English company who are selling debt in Scotland, then they may not be aware of the regulations, although they really should be aware of the regulations that they're selling the debt under. And HMRC now tend to reject all applications, and they just allow the case to go to the fair and reasonable test and let the accountant in bankruptcy make a decision on that. So what's the conclusion? Introduction of business DAS, well, I think is a positive development. DAS will continue to be a viable solution for individuals and sole traders. And the business DAS, as I said, there currently is only one business DAS in existence, which we've set up, but it's yet to see if that's going to take off. I think one of the problems, as I said, I was on the business DAS working group, and they set the term at a 5-year maximum. We did discuss with them at that point that this may be a problem for a lot of partnerships who were looking to go into the scheme, because a lot of businesses are still viable, even if you were setting it longer than 5 years. So I think what's going to happen is there's going to be a review, as there was when the initial DAS regulations came in. There's going to be a review in a year's time, and they've already talked about extending the term past 5 years. So it's yet to see what happens with that. The Financial Inclusion Commission made a recommendation to adopt Scotland's debt arrangement scheme for the whole of the United Kingdom. So again, it's yet to be seen if that's going to happen, but certainly I think that would be a good thing if that was to come about. So business DAS as a lifeline for sole traders and partnerships. Well, I would say yes, definitely is, but obviously I'm a bit biased. Although it's yet to be seen how long DAS cases which are currently running will continue to do so and repay the debt. We have had some DAS cases which are for a shorter term, 3 or 4 years, which have actually paid off the entire debt. So they have been successful in that respect. And again, it's yet to be seen what happens with the increase in the term of the business DAS, if that's going to be something which happens. Hopefully it will be.